Benefits and drawbacks of direct investing versus investing through fund managers. A family office's abilities and experience in portfolio management and investing are often an important consideration for prospective clients. But what exactly does portfolio management mean? Does the portfolio include investments in specific companies, real estate holdings, or other assets, or in independent funds that, in turn, invest in a variety of opportunities? Through our research, about 36% of family offices primarily invest their clients' capital with alternative investment fund managers. About 24% invest directly into companies and real estate. And about 40% have a mixed approach, doing some direct investing and some investing in funds. In this video, we will look at the benefits and drawbacks of direct investing versus investing through fund managers. Let's start with investment funds. There are many kinds of funds that pool together other people's money to make a number of relatively large investments in specific asset classes. Within the private equity sector, there are four main kinds of funds. 1. Venture capital. 2. Private equity. 3. Hedge funds. And 4. Real estate funds. Each of these types of funds generally follow a similar process. The first step is to raise millions or even billions of dollars from family offices, pension groups, retirement plans, insurance companies, or other large investors for a specific purpose or fund. These funds often have fixed time horizons, such as 10 years, in which to invest, grow, exit, and return capital to investors. During the first 3 to 5 years, usually, they make investments in their specific niche. They have teams of people identifying, analyzing, performing due diligence, and negotiating with potential investment opportunities. After the investment is made, someone from the firm may work part-time on each investment to increase its value. Typically, the goal is to grow the value of the company or asset for a few years, then sell it for a higher price than they paid. Buy low, sell high. By the time the fund reaches its maturity date, it needs to return all of the investment proceeds, minus fees, to all of its initial investors. We'll talk about these fees in a moment. Investing through fund managers is like outsourcing. In this case, you're outsourcing the investment decisions to experts you hire and oversee. This is a main benefit for investing in fund managers, letting specialists do the work for you so you can focus on your strengths. Outsourcing investment decisions is often a great fit for a smaller family office that doesn't have the resources to manage specific investments. There are other benefits as well. For example, the ability to leverage other people's money. Your family office may represent 5 to 15% of the total investments managed by the fund. If you commit $10 million into a fund, your investment is pooled with $60 to $200 million from other sources. This, of course, allows your clients to own a piece of much larger investment opportunities than they could on their own. The other main benefit of this leverage is diversification. Your client's money can be deployed in many more companies or assets through the network and skills of the fund team than you may be able to identify and manage directly. In addition, many family offices are already set up to select and work with fund managers for public markets or indexes, mutual funds, or money market funds. It is easier to add private equity funds to this mix than to add the capacity to invest directly. What are the key drawbacks of fund managers? Fees. Most funds operate under the 2 and 20 structure. This means the fund takes 2% of the total committed capital for overhead and salaries, plus 20% of the carry or profit from investments. Second, you are committed for a set amount and time period. A moment ago, we talked about an example where you commit $10 million to a fund. The way it actually works is the fund makes capital calls only when the money is needed. When the fund managers decide to make an investment, they contact you and the other limited partners, telling you how much money you need to send. Why is that a problem? Here's an example. Let's say you commit $10 million to a fund and you send only $4 million in the first 3 years. What if the economy takes a nosedive, or your family clients' preferences change? Or you find an alternative investment opportunity you like better than this current fund, for whatever reason. You are still committed for the remaining $6 million if the fund decides to make investments on your behalf. A third drawback of investing in fund managers is your limited control. In fact, if your family office invests in a fund, you become what's called a limited partner in that fund. By definition, your ability to influence control over the investment decisions and management of the firm is limited. It is important to select the funds and fund managers carefully. So one alternative is to make direct investments into private companies, real estate, or other alternative asset class opportunities. Essentially, cut out the middleman, if you will. This is usually only an option for larger family offices, with the resources and expertise to provide this service. The most obvious key benefit of direct investing is the fact that you can avoid paying the potentially million-dollar fees to a third party. This is possible if your office has the ability to make direct investments on your client's behalf. If so, this ability is a potential key differentiator for your family office. If your family office develops a track record and earns a reputation for making good investments, you can leverage that to attract more clients. Clearly, this is a benefit. And because you are providing a valuable service and helping your clients avoid the fees charged by fund managers, you might be able to charge higher fees yourself and still provide a greater net return for your clients, assuming you make good investment recommendations for your clients. Part of your role as investor may be to help manage the company, property, or other asset to maximize shareholder value. By investing directly, you have a higher level of control over investments than you do when someone else, such as fund managers, are managing those investments. Another benefit related to control is transparency. Fund managers have certain requirements on what they report to their limited partners, and some fund managers elect to report even more details. But there is always the possibility that some important facts are hidden in data or skewed to protect the interests of the fund managers, not your family clients. To summarize, direct investing can avoid external fees, provide your firm a competitive advantage and potentially higher fees, and give you more control and transparency on investments. But there are a few key drawbacks of direct investing as well. First, due diligence. While it is certainly a lot of work investigating and assessing fund managers, it can be a lot more challenging to confirm and validate the opportunity for specific real estate properties in a different state or country, or startup companies with no track record and a complicated business model. At minimum, consider this. There may be a few thousand current funds looking for investors at any given time. They all have websites that can be found using a few key search terms. On the other hand, there are 700,000 new companies started each year looking for funding and millions more potentially looking for a buyer or an investor. On top of the sheer numbers, does your family office have people who can assess a company's operations, market, technology, management practices, and financial health? Or evaluate and grow the value of various real estate properties or foreign exchange markets? Direct investing requires a very specific skill set that takes years or decades to develop. This skill set also needs to include oversight. If your office invests in 10 companies or 10 properties instead of in one fund, you will need to keep tabs on 10 different investments. Many top family offices we've spoke with mention the value of making on-site visits to fund managers. These family office executives, or at least someone on their team, will make a visit to the fund during the due diligence process, and some family offices even visit regularly after the capital is committed to keep up with the manager and to understand how the fund is performing and what factors are affecting the investment. Does your office have the ability to meet with all the direct investments? We mentioned before that you can charge higher fees if you make direct investments, but part of these fees will likely be needed to hire experienced investors and managers, so your internal overhead costs increase as well. Conclusion. As you weigh the pros and cons of direct investing versus investing in fund managers, it is important to keep your clients' preferences in mind. Do your clients want a hands-off solution, or do they want you to control the direct investments of some of their capital, perhaps into an industry that they are familiar with? A multifamily office will often adapt to fit the needs of its clients, or those clients it hopes to attract, by specializing in certain services, or offering a suite of different services that a prospective client may or may not need. This may be tougher for smaller single family offices with more limited resources. In either case, I hope this discussion has helped you understand more of the differences between direct investing and investing through fund managers.